Hello traders, how you guys doing? It's Daniel FX right here. So today we are going to be talking about chart patterns. So welcome every single one of you on another price action video on the arc. So just as we have discussed a lot of concepts on this mentorship, but today we're going to be talking on a very important aspect of this mentorship or this price action course, which is understanding chart patterns. So we're going to be talking about different chart patterns, and we're going to be starting off with the cup with handle kind of chart pattern. So without wasting more time, we're going to dive into it. So we will start from here. So looking at the market is coming from like up destination to a downtrend. You can see the market's pushing to the downside, coming to this price level. It forms this cup shaped pattern. Like you can see how slopey this price level is. You can go to your charts. If even you see this chart pattern, so you're going to understand and see how all the wicks, all the lows are rounding up itself and pushing to the upside. So this kind of pattern, this pattern format a key resistance level. It consists of a rounding bottom, the cup, and also followed by consolidation, which is the handle, and a breakout from the handle as well. So this is the resistance. It forms this cup below the resistance. You get it. So this is the resistance right here, and this for this cup pattern is the shape of pattern is being formed below it. You can see the way I just mapped it out for you guys to be able to understand it. So after getting to the this is the first touch, and the market comes back to this resistance price level. The market tries to like form this kind of movement that make it feels like it wants to push to the downside. No, it does not push to the downside. The market end up going to the upside. So this first touch right here, you don't want to be jumping into the market. You want to see the market come to this resistance level right one more time, come to the downside, and just like I taught you guys, you want to be entering the market like a professional trader. You want to be entering at the second entry. So right here, you get your breakout. So when calculating your take profit, you want to measure the range from down here to up here, this resistance level, then bring it out and measure it. So that's going to be your take profit measurement. You set it right there on the chart. So just for you to understand it, this is your resistance at the top here. It forms this resistance at the top, then it goes from all the way down to the downside, going to the upside. Then we have a breakout. Then the market drops into which forms the cup handle. Then you don't want to enter the market immediately it comes to this price level. It can be a first breakout one more time. The market coming back to this price level, this swing low right here. So always take the swing lows for your entries, the weeks of the swing lows for your entries, because the market might come and sweep liquidity. So let's move forward. So let's talk about double tops, double bottom. Yes, double top, double bottom. So we're going to talk about a double bottom at the support level. So the market comes all the way from here down to the downside, gets to this price level. You can see by pressure. Maybe this is your POI, maybe this is your other block, maybe this is your higher time frame point of interest, and the market start pushing to the upside from this support level, and the market start pushing to the upside. It gets to this price level, maybe a low probability other block right here, and the market drops one more time, coming to this price level one more time. You want to enter the market here as a smart trader, forming a double bottom, and the market push to the upside. When this breaks past this resistance right here, it will also form another double bottom in most cases, which is another support, because resistance has turned support for you. So you want to enter here. Do not enter here. You enter here. This is where you're going to be entering the market as a professional trader for your second entry. So it forms double bottom here and double bottom here. The same case for the double top. So the market's coming from the downside, gets to this resistance level, and the market drops to the downside, comes to it one more time, test it, and it forms a double top right here. The double top, you don't want to be entering the market here immediately it comes to your POI. You want to wait for a reversal. The reversal forms the pattern. So What is the catch? You want to wait for these patterns at your key levels. You want to wait for these patterns. Most especially, this is double top, double pattern, double top, double bottom. It always forms at key levels. It always forms at key levels. So you don't want to enter the market immediately the market comes to your POI. You want to see a reversal coming back to your to that POI. The second reversal to your POI is going to be your master entry. So the same stuff I thought I explained to you guys here. You see the market coming, turning this support to resistance right now. And whenever the market is coming to the second time, or this one, you see it, the market normally sweeps liquidity. In most cases, it normally goes all the way up, sweeps liquidity. You get it, or some cases like this, grabs liquidity, internal liquidity, and go for external liquidity. So we are now in the head and shoulders pattern. Head and shoulder pattern. I Most of you guys know about this one. We have head and shoulder, inverse head and shoulder pattern. So for this head and shoulder patterns, just as you can see already on the screen, I've already mapped it out for you guys to be able to understand that this is the right shoulder, the left shoulder, and the head itself. So this head forms at a resistance level. The market's creating this lower high, higher high, higher low. I mean to say higher high, creates a lower low, higher low, creates a new higher high, uh, drops down to this higher low right here, breaks below it. This is like a fake breakout. Fake breakout, it just takes out traders like the early buyers, and they are out of the market. The markets fake traders who lack the understanding to understand how the forex market actually works. They will be in for a sell. Most traders will see the market has broke structure. The market did not break structure. The market only come to grab liquidity. The market goes all the way up here, gets this neckline you see here, and notice, just to remind you, it always respects this neckline. It might be a long candlestick wick, but it always respects the neckline. So it creates the left shoulders. So when the market breaks out, it breaks with full body candlestick. Now this is a proper breakout, not a fake out like this one. This is a proper breakout. But you still want to wait for the market, because the market will always reverse to this breaker block, because this will automatically turn a breaker block right here. So you want to enter the breaker block, set your entry here, your sell limit to the downside with your stop loss at this high right here. So let's move forward. Let's move to the inverse head and shoulder right here. So we have an inverse head and shoulder right here. So this is the head, left shoulders, right shoulders right here. Same explanation, and you can see the market pushing to the upside, a fake out causing a liquidity sweep. The market drops in back into the pattern and forms the pattern completely. Always mark out this high. The high that was previously created when the left shoulder was created, you want to see that high being respected when it comes back. You get it? You want to see that lines being matched. So it creates the right shoulders and the market push to the outside, creating a proper breakout with full body candlestick, buy pressure in the market. And you don't want you want to be patient with the market. You want to enter here when it retests this resistance that has now automatically done support. And if you are a support and resistance trader, this is going to be your entry, that resistance done support. But if you trade SMC, this is going to be your breaker block for your entry. So let's move forward and let's talk about the ascending triangle and descending triangle. So for the ascending triangle, we have a movement, we have a market in a ranging, like the market is on the, like it's ranging to the upside, but it's on a, like an ascending triangle. The market is ascending to the upside, but is in a triangle shaped pattern from here to here. So if you want to calculate your take profit, you want to measure up from this price level down to this price level. You want to measure it out when it breaks out from the range. You want to measure it as your take profit. So most times the market does this fake out. Maybe in this kinds of places, you see the market does fake out. This is to intrigue traders into thinking that the market wants to break out and can start going to the downside. in these situations, traders who lack the ability to understand how the forex market actually works, they are being taken out in this situation. That is where you see traders hitting stop loss. And you can see the market running back into the triangle pattern, and the market pushing to the upside, maybe having a proper breakout. Most cases, it just came to grab liquidity around this price level, pushing to the upside. You want to wait, like I always say, for this is a proper breakout. The proper breakout is going to be caused by full body candlestick. Full body candlestick, not candlestick wicks. The market retesting this price level, maybe this resistance right here, resistance don't support, or a breaker block. This is a breaker block, and the market start pushing to the upside. So this is going to be your entry right there. So the same with a descending triangle. For a descending triangle, the market creates or accumulates this large um, liquidity right here. And when the liquidity is finally grabbed and the market has a proper breakout, you want to have your entry right here. Resistance supports now turns resistance for you. And you have to be very, very careful because you might have or see multiple fake outs happening with candlestick wicks or up closed candlesticks. In this kind of situation, you will be seeing candlestick wicks or down closed candlesticks. So for our last example, we are going to be using for this chart patterns explanation, we are going to be talking about the falling wedge, and we are going to be talking about it in two different situations. First situation is when the market is on an uptrend, and when the market is on a downtrend. So in this situation, the market is on a downtrend. The market creates this, the market is on an uptrend, but automatically the market turns start going to the downside. So it creates this upward movement in the market, intriguing traders into thinking that this market wants to start pushing to the upside, creates this uptrend movement. This is a fallen wage, rising wage. I mean to say, this is a rising wage. The market start pushing to the upside. All of a sudden, you see this breakout in that range right there. So this is one is for a continuation movement. You can see how it's been formed. The market creating these waves you see, and the market breaking up to the downside. So this is a falling wedge, and this is a rising wedge. A rising wedge, and this is a falling wedge. This is going to be your entry right here. For the rising wedge, the market is rising to the upside. Rising to the upside, you want to be patient for a breakout, and you want to be very, very smart enough not to be tricked with false breakout right here. And all of these examples I'm just giving you guys. So the market breaking to the outside, downside. This is a continuation movement. This is a continuation movement. This is for a downtrend. A downtrend right here. The market from a downtrend turns into an uptrend, and this one from an uptrend turns into a downtrend. So these are all wages in the market. This is all wages. Yes, you can see all these wages are being created. This might take times. Most time it might form in lower time frame. Most time it might form in higher time frame. The main thing you want to be very careful. You don't want to fall into fake out. Most especially, you want to wait for full body candlestick breaking out of this ranging movement right here. So I think I still have more examples. Okay, we have the bullish flag pennant and the bearish flag pennant right here. So this bullish flag pennant and bearish flag pennant are continuation patterns, like their continuation patterns. I try to tell you that the market is continuing the movement. So it creates this pattern to accumulate liquidity. The main reason why the market does all of this stuff is just to accumulate liquidity. It grabs the liquidity at its own due time. So for this bullish flag pennant, the market creates this waves of movements, and most times you see fake outs happening, then you see a breakout, you see a retest, then you see a continuation in the movement. So this is for an uptrend. The market's continuing its initial movement, which is this buy pressure you see right here. And last but not the least, we have the bearish flag pennant. So there are a lot of examples of all of these stuffs, to which you can go into your own due time and check it out. So the same example, fake out happening, full body candlestick breaking out of the waves, breaking out of the flag, and you see a retest, which is going to be your entry. Same as this price level right here, the retest it's going to be your entry. So thanks for watching, guys. I think I've been able to explain better for you guys about some chart patterns, so you can go make your own discovery, do your own research, and understand how all of this chart patterns affect the forex market. Thanks for watching.